Okay, good evening once again. In our last class, we started portfolio theory, capital asset pricing model. We have looked at the concept, the necessary formula, and of course, we have solved 2 questions on portfolio theory. So I believe we have gone through that. Because we are not able to conclude that, that's why I said, let's have one more class. And God willing, if we're able to cover portfolio theory, I would also like to go to bond valuation as well today, so that we are sure that you will have covered offshore pricing theory, which we have actually had, portfolio theory and CAPM awards, and the bond valuation and the analysis. So without wasting our time, let us look at example number 3 here. Let us look at example number 3. The following data were sourced from an investment bank. The following data were sourced from an investment bank, OPIC Merchant Bank. So we have company A, company B, company C, company D. These are the forecast equity return. These are the standard deviation, and these are the covariances. And the market return and market standard deviation, the market return and market standard deviation are 14.5% and 5% respectively. And the risk-free rate is 6%. Return and all other data related to year report estimate the alpha value. Estimate alpha value for each of these companies' shares and explain what use alpha values might be to financial managers. B, briefly discuss the reason for the existence of alpha values and whether or not the same alpha value will be expected to exist in 1 year time. So that is the question. Before we solve the question, it is important that we know what alpha value really means. When we say alpha value, what do we mean? Alpha value is the difference between expected return on an investment and the required return on that same investment. I repeat, alpha value is the difference between the expected return on a security and the required return on that security. Is what we call alpha value. That's our alpha value. So in mathematical terms, we can say alpha value is equal to expected return minus required return. Let me say that we have the symbol for alpha. Alpha. Okay, this alpha. Okay, that's the symbol for alpha. So alpha value, like I said, is what? Is the difference between expected return. If I'm to write this in a book, it will be this R, I will put a bar on top of it. Do you understand what I mean? I will write this R, I will put a bar. I will not write E if I'm to be writing in my notes. It's because I'm writing on Word document. That's why I put ER, expected return. But normally, it should be R bar, R with a bar on top of it. I think we have done this in our previous class, expected return. So the difference between this and what we call required return is your alpha value. That is our alpha value. Now, alpha can take 3 different values. Okay? That is, we can have 3 values for alpha, and both of them will be interpreted in different ways. But before we look at these values that alpha can take, can we briefly explain what is the use of alpha? What do we use alpha to do? Alpha value is used by investment bankers to identify what security, let me say shares in this case, should be bought, which share should be sold, and which share should we retain. So 3 different decisions. Alpha value can be used to decide on the share to buy, the share to sell, and the share to hold. So before a broker, we say we advise a client to sell a particular share or any security for that matter. The broker will have computed the alpha value of that security. So when you get the value, based on the value, you will not be able to advise that client appropriately, whether to sell, to hold, or to buy. Now, if my alpha value, if you compute your alpha value, okay, you compute your alpha value, and what you have is positive figure. You discover that your alpha is positive. If alpha is positive, it is interpreted to mean that the stock is undervalued. What does that mean? It means the actual worth of the shares or security is higher than what the market discloses. So the share is underpriced in the market. So when the share is underpriced, the strategy you are going to advise your client to undertake is that more of the shares should be bought, because it means you are buying at a lesser price. For instance, something that is actually worth 100,000, you now see it as at an offer of 70 or 80,000 naira in the market. What does that mean? It means that particular item is underpriced. So what will you do? If you want to buy one before, what will you do? You will buy more, because you know that the worth of that particular item is actually more than what the rate at which you are getting it in the market. So when it's the alpha of a security is positive, it means the stock is underpriced. And strategy that you are going to apply as an investor is that you are going to buy more security. Number two, if your alpha value is negative, it is interpreted to mean the security or the stock is overvalued market, meaning that the output of the share is not up to what the market is disclosing. So if you have a share, what will you do? You sell, because you will sell to a gain. In the price is actual price is what? Maybe the actual price is 10 naira per share, but the market is pricing 12 naira. I am having that share. What will I do? Sell at 2 naira, because I will make a 2 naira gain. That 2 naira gain is what we call abnormal, okay? Abnormal gain. Number three, if your alpha value is equal to 0, it's not positive, it's not negative, it is 0. Now, that will be interpreted to mean that the security is what? Is correctly priced. Let me put this one there. This one is a value, undervalue. This is undervalued. And when it is undervalued, what do? You buy more. Buy more. This one is what? This one is equal to overvalued. So if it is overvalued, what's your strategy? Sell. Sell. If it is 0, it means it is what? It is correctly priced or valued. Correctly priced or correctly valued. Don't forget, if I say valued here, it also mean what? Price. Undervalued or underpriced. Okay? Here, overvalued or overpriced. And here is what? Okay, let me put it here. Correctly valued or correctly priced. So, where a security, so correctly priced, it means you cannot make that stock because the market already disclosed the exact price of that security. So you cannot make a gain by buying more of the shares, nor by selling the one you have at that existing price. That is for a stock that is correctly priced. So these are the three scenarios you can have: undervalued, overvalued, and correctly valued or priced. Any question on this? From what I've said so far, do you have any question before we continue? Please let us respond on time. We have a lot to do this night. We have a lot to do. Nobody is talking.
Go ahead, sir.
Okay. So the question now is, for me to get alpha value from what we discussed here, we said we need what? We said alpha is, okay, this is here, minus required return. I don't have problem with expected return because we have already covered that. If you remember, we have covered expected return. But to refresh your memory, I will go back and show you. This is what we call our expected return. For instance, return times probability, return times probability. The sum of everything here is what we refer to as the expected return. So that's why I said we have already covered that. I don't have problem with that. But required return, how do I compute my required return? Computation of required return. Now, required return anyway, we have also done that, but until I write out the formula now, you won't remember that we have done it, but I will let you know that we have done it now. When we say required return, we use the capital asset pricing model, CAPM, to compute what? Use CAPM to compute required return. To compute required return. Use CAPM to compute required return. And what is the formula? Everybody knows. Which is what? Return, the one you call cost of equity. Okay, that's the return there. Return on equity. So return is equal to risk-free rate plus beta of equity into bracket. But here, I will not say beta of equity. I'll just put beta because I might not be dealing with equity. I might be dealing with other stock as well. So I'll just put beta. Risk-free plus beta into bracket, return on in the market minus the risk-free. So you can't tell me that you have not seen this formula before. Or have we not seen it before? Of course, everybody has seen this several times before. So this is the formula you need to compute your required return. The only thing I want to discuss as an addition is how do you compute your beta? Don't misquote me. You want to argue with me that when we are doing project-specific cost of capital, we better. Not put better there. The question will give you better. Maybe the beta of the process is 1.4. What I just do is that we are converting from one type of beta to another. Maybe you are converting beta of equity to beta of asset, and from beta of asset to beta of equity, but you are not computing beta. You are only manipulating beta from one form to the other. Do you understand? So this is where we need to compute that beta. That beta you have been using before. How do we compute that beta? Now, beta can be computed in there's a three or even 4 different ways. Okay, in 3 or 4 different ways. Now let's see the various formula for computing beta. The formula we are going to use will depend on the nature of the information given. Okay, it will depend on the nature of the information given to you. So let us look at each of these formula for computing beta. So I can compute my beta. Let me call it formula for computing beta. Beta can be computed as formula 1. Formula 1. I can have my beta to be equal to covariance with the market. Covariance with the market. Okay, let me put it in a better way to understand. Covariance of the stock. Covariance of the stock with the market all over variance. All over variance of the market. There's one formula. Now, when do you use this formula? You will use this formula to compute beta where either the question has given you covariance of the investment with the market and variance of the market, or where it is possible for you to compute your covariance. We have seen how to compute covariance. However, in the exam, most likely, if you are going to compute beta, most likely the question will have given you covariance with the market. So it is very rare. In fact, I've not seen where in the computation of beta, the candidate is required to compute the covariance. So most likely the covariance will be due. But if it is not given, remember, we have computed covariance before. Where do you have that covariance there? You can see covariance. But this covariance here is not covariance with the market. It's covariance with of the two words of the two investments. Do you understand? You can see this word. Deviation of A. Okay? Deviation of A times deviation of B. So if I'm dealing with covariance of the market, instead of having, for example, I may have for A as a share. Now, I now want to look at what is the covariance of investment A with the market. So if I'm looking at the covariance of the investment A with the market, it means where I have B here, I should have the market return. So I will have the return on the market, the probability, then the what? The expected return on the market, then compute my what? Compute my deviation. When I'm not done with deviation, I will now come here where I have A, I will have deviation of the market instead of deviation of A. So in simple terms, it will mean that deviation of the market times the deviation of what? B will give me this instead, then times probability will give me this. Deviation of the market times deviation of the share times probability will give me this. So I will now add everything together. I will have covariance with the market. So the difference between this and that is just because this A, instead of investment A, you just have market return. Okay, return on the market. So where you are computing your beta using this approach, then it's either you are computing the covariance now formula. We can also our beta standard deviation. Let me see, do I have standard deviation again? Okay. Standard deviation of the security, which is the shares, multiplied by the correlation coefficient of the investment with the market. Correlation coefficient of the investment with the market. Everything here over standard deviation of the market. Standard deviation of the market. That's all. So when do I use this? I will use this where the question gives me standard deviation of the investment and the correlation of the investment return with the market and the standard deviation of the market as well. However, where correlation is not given in some question, correlation will not be given. If correlation is not given, please, you don't have to be wasting your time. You just use the you just use the standard deviation of the investment over standard deviation of the market. As simple as that. If there is no word, let me take it as a note here. Note. Where correlation is not given, just use the standard deviation of the stock divided by the standard deviation of the markets. That is where my what? Where my correlation of the investment with the market is not given. So you will not bother yourself. That's 2. So it therefore means that if I want to follow the one I have there, if I want to follow that note now, I can say that my beta, is standard deviation of the investment over standard deviation of the market. Fine. Number 4. We can also compute our beta as, instead of standard deviation, I can have variance. Variance of the market, variance of the investment. So that will be square. Standard deviation square is variance. Standard deviation of the investment multiplied by correlation of the investment with the market, variance over variance of the market. So you see that the difference between 4 and 2 is just that in 2, we use what? We use, what do you call it? We use standard deviation, but here we are using what? We are using variance. Of course, when we are using this, you need to take the square root of this. Otherwise, your solution will not be right. Square root of variance is, in fact, I will even advise. Let me remove this one for you. Let me remove it. I will advise that where you are given variance, just convert it to standard deviation. And you know how to do that. Just take the square root of the variance and you get your standard deviation straight away. So if you look at the question and see that what the question has given is variance, take the square root of the variance to get your standard deviation. Okay. Another way of computing beta is So basically, these are the three formula for computing your beta. So the moment you have your beta, you now go and compute your what? Your required return. So take away your required return from your expected return, you get your alpha value. That is how to the now. What's this one? Ah. Oh God. What is this one? Okay. So this kind says we should estimate the alpha value for each of these companies' share and explain what use alpha value might be to financial managers. So let's see. Now look at it. I have my forecast equity return. Forecast means expected. Don't let any examiner use it to confuse you. Forecast there means what? Expected return in the future. What you are getting in the future. That is forecast. So we have been given expected return. We need to calculate what? Required return using CAPM. Look at it. We have market return. What's the market return? The market return and market standard deviation. This is the market return. This is the market standard deviation. Market return standard deviation. So what will I do? Do I have correlation? No. There is no correlation. Abi? There is no correlation. So how do I compute my beta? Because before I can compute my required return, I must know my beta. So I will compute beta for company A's share. And how will I do that? Standard deviation of company A's share, okay, over standard deviation of the market. I'm coming. I want to confirm something. Okay. Do we have covariance for the market? You know, you can also compute your beta using covariance, Abi. From what I discussed, I can say covariance of the investment with the market over covariance of the market. But I don't think we are giving covariance for the market. There's no covariance for the market. So I won't bother myself. Even though there is covariance, I won't even use that. I will prefer using what do you call it? Standard deviation. So standard deviation of company A share is 6.3. And what is the standard deviation of the market? 5. So you now say 6.3 divided by 5. 6.3 divided by 5. I'm having 1.26. That is better of A. You do the same thing for B. 4.8 divided by 5. You do the same thing for C. 4.7 divided by 5. 6.9 divided by 5. This will give you the better of all the shares. And that is requirement A. Sorry, no, that's just a better. That's just better. When you are done, now go and use your information here. Risk-free rate plus your beta into bracket market return minus risk-free rate will give you your required return. When you are done with your required return, remove your required return from the forecast, you get the alpha value. It's as simple as that. So let's go and solve this question. A. Computation of alpha value. Computation of alpha value. That's requirement A. Step 1 is to compute what? Compute the beta of each security, or we call it stock, or shares. Compute the beta of each security, stock, or we call it what? Shares. So let's do that. What do you have as A? I believe you understand it now. Beta, I'm going to compute my beta as standard deviation of the investment over standard deviation of the market. That's it. Because that is the information I have in the question. Out of those I gave you, that's the only one that is applicable to this question here. Now, for company A, beta will be equal to 6.3 over 5. That will give us what? Give me the figure. Give me the figure. 6.3 over 5 will give me what? You have all slept off. Are we sleeping?
Mm.
Well, give me figure now.
$1.26.
Ma?
1.26.
1.26. You go to company B. What is the standard deviation of B?
4.8.
4.8 over 5. What is that giving us?
0.96.
0.96. Come to company C. Company C. What is the standard deviation of C?
4.7.
4.7. So where is it better?
It's 0.94.
0.94. Companies D. What is the standard deviation of D?
6.9.
And that gives us what?
1.38.
2 points.
1.38.
So you have computed the beta of the security. This is how to compute beta. It's no more than this. You have computed beta of the security. Now, you now go and compute what? That's step 2.
I have a question, sir, please.
Yeah.
The market standard deviation of 14.5%. Can't we use it as the variance of the market that is buying?
That's what? That
this market standard deviation, is it different from standard deviation of 5%? Can we convert standard deviation to variance?
Why do you want to convert it?
No, I'm just asking because you said something when you were writing.
Yes, now you know. I said standard deviation. The square of standard deviation is variance. Square root of variance is standard deviation. What do we do here?
But you were saying that you don't have information for variance. I said alternatively, can someone use this standard deviation?
I'm only telling you we don't have correlation. I didn't tell you we do have standard deviation. I said we don't have correlation.
Okay.
I said we don't have correlation. I didn't say standard deviation. There's no correlation between these shares and the market.
All right.
If there is correlation, I will have multiplied correlation. I will have said 6.3 times the correlation before I will divide.
Okay.
Do you understand?
Yes.
So it's correlation I'm referring to, not a variance. I don't need variance for anything in this question. I don't need the variance for anything. If you leave this one here, you convert 5 to variance, you have 25. If you now say 6.3 over 25, it doesn't have any meaning again because you are dividing standard deviation by variance. Do you understand? It has to be standard deviation, standard deviation, or variance, variance. Is it clear?
Yes, sir.
Okay. I'm sure you understand those terminologies so that there's that. You not be taking standard deviation for variance or correlation. standard deviation for correlation. You understand this? Ensure you understand the logic. Now, step 2, we have to compute the required return. Compute required return. So, required return for company A now my return, okay, let me put the general formula first. Return is equal to risk-free plus beta market return minus risk-free. Do the formula. Now, for company A, so for company A, my return will be, what's the risk rate? 6%. Going to be correct. Let me check. That is correct. 6% plus, what is the beta of A? I will do while you complete the rest. Just give me your figure. Beta of A is 1.26. So I say plus 1.26 into bracket. Market return is 14.45 minus risk free of 6. What do we have there? I'm waiting though. Hello? Are you there? Are we sleeping? Give me the figure now. Press your calculator and give me the figure. Okay, nobody is ready to give figure, no problem. Let me continue. That's my calculator. So I have, okay, this is 14.5, sorry. So I have 16.71. So 16.71 for company B. Beta of company B is 0.96. Did there. 0.96 and my return will be 14.5 minus
14 points.
minus
14, is it 14.1?
16.
14.1.
16. Six. 0.94.
$19.99.
99. And this 1.38. Times 1.38.
17.7.
2.73. So these are my required return. These are my required return. I cannot go ahead and compute my alpha value. To compute my alpha value, 1, 2, 3, 4. 1, 2, 3, 4. So I will have company, expected return, required return, alpha value. Now, let me add one more column to this. Okay. Now, company A, company B, company C, company D. The expected return of company A is 16.88. The required return is 16.71. $16.88 minus 16.71. I have 0.17. 0.17, and it is positive. 0.17, and it is positive. Because it is positive, what will be my strategy? What should be my strategy? The strategy is that I will buy more. I will buy that share, buy more. Because it means the share is undervalued in the market. The share is undervalued in the market. So I will need to buy more so that I can have them at a cheaper price. Then for B, the expected return for B
is 12.0.
required return is 14.16.
0.16.
And alpha value is
minus 2.16.
So I need to sell the security because it is overvalued. Security is overvalued, so I will need to sell that security in order to make a gain. So I will sell that security. I will now look for security that is undervalued and buy. I will sell the one that is overvalued and look for the one that is what? Undervalued to buy. So do for D, for C and D, and give me your answer. Everyone should attempt that. At least I've done 2 for you. Try and do C and D. And let's see how far you have gone.
For C.
For C is what?
The alpha value is 0.01. 0.01.
0.0. So what do we do? It is a buy. Then for D.
D. 3.77.
What do we have now for D?
3.77. The alpha value.
3.77. Positive, Abby?
Positive, sir.
Huh?
Positive.
So buy. This is how to use your alpha value to make a decision. That's how to make a decision using alpha value. So if I use this alpha value at a glance, I can see that I need to buy more of A, C, and D, but I need to sell B. So let's go to the B part of the requirement. Briefly discuss the reason for the existence of alpha value. Briefly discuss the reason for the existence of alpha value and whether the same, or whether or not the same alpha value will be expected to exist in 1 year time. That's a B part of the requirement. Now, why do we have alpha value? Why do we have alpha value? Okay. Alpha value will exist where the market is not efficient. I repeat, alpha value exists where the market is not efficient. Efficient means that market or price of stock in the market reflect all possible information. In any efficient market, the price of a stock will reflect all available information. So at all time, the stock will be correctly priced. But where the market is either weak form or semi-strong form efficient, then share will not reflect all available information. Sorry, the share price or the stock price will not reflect all available information. And in that case, it's either the share is undervalued or the share is valued. Therefore, there will be alpha value. So that is the reason why you can have alpha value. Okay, that's the reason why you can have alpha value. Now say we should discuss whether or not the same alpha value will be what? Will exist in 1 year time. Are you with me? Hello? Hello?
Yes, also.
You are the only person talking, the others are not saying anything.
I'm here, sir. I'm here, sir.
Okay. Now, we have discussed the reason why we have alpha value. The next one is the alpha value today going to be the same alpha value in 1 year time? That's the question now. Will the alpha value today be the same with the alpha value in 1 year time? The answer is no. The answer is no. Why? Because I have told you that alpha value exists because the market is not efficient. Now, as new information comes to the market, the price of the share will change. The price of the share will change as new information gets to the market. So, if the market is at least semi-strong form efficient, then the share price will at least be very close to correctly priced, even though there will still be little variation between the expected return and market return. But the alpha value now will not be the same in 1 year time because the price of the share will have reflected the new information that will be available between now and in 1 year time. Let me give you a brief note on that. Are we ready? I want to dictate for you, I'm not writing.
Yes, sir. We are.
Okay. Alpha value exists. Alpha value exists. Alpha value exists for shares or securities, alpha value exceeds for shares or securities in a company, in a market that is not efficient. In a market that is not efficient. And therefore, the share price is either undervalued or overvalued. As a result of variation, between the expected share price and the required share price. Are we there?
As a result of, sir. As a result of.
I forgot the way I put it. Who has written it completely? Should just read it out so that I will not give you another sentence again. Who has completed it?
Therefore, the share price is either undervalued or overvalued as a result of.
Okay, that's how you stop, Abby. That's how we stop. Okay. As a result of the share price, sorry, the what do I call it? The expected return on the share. The expected return on the share being different from the required return.
Okay, sir.
Paragraph. Alpha value will change. Alpha value will change and approaches zero. And approaches zero. And approaches zero as new information are released into the market about the company. Okay, as well as a sort of new information being available in the market, Abby, being released in the market, right?
Being released into the market about the company.
Okay, about the company. Thank you. Full stop. Therefore, the alpha value today cannot remain the same. With the alpha value cannot remain the same with the alpha value in 1 year time. Have we written that?
Yes, sir.
So that is that. That's all about question 2. Now look at question 3. You are going to compute this for me. As an investor in an equilibrium market containing many different assets, you currently have 50% of your wealth in risk-free assets and 50% in the 4 assets below. We have asset A, B to D. We have expected return. We have beta investment. We have investment in assets. Now, sorry. Required. Calculate the current beta. Calculate the current beta and expected return of your portfolio. Calculate the current beta and the expected return of your portfolio. Now, let me show you the difference between the requirement of this question and the one we just did. The question we just finished here, what we computed is what? The beta we computed. The beta of the individual what? Individual security. You can see. Hello?
Yes, sir.
Yeah. One investment cannot be called a portfolio. You should understand that. The way you hear portfolio, portfolio is more than one investment. It starts from 2. So if the question say compute the beta of portfolio, it's not beta of the investment. And as you can see, even from here, you see that the beta of the investment has already, of the security, have already been given to you, Abby. So they cannot ask you to compute that same beta again. So what the question wants you to compute is the beta of the portfolio, a single beta that will represent the portfolio. This portfolio now is 4 asset portfolio comprising 4 assets. So what is the beta of my portfolio? How will I get that? The beta of a portfolio, get me right, the beta of a portfolio is the weighted average beta of individual assets in the portfolio. The beta of a portfolio is the weighted average beta. Can you hear me?
Yes, sir.
Yeah. So beta of a portfolio is the weighted average beta of the individual, what do you call it? Individual asset or security in the portfolio. So if I want to compute the beta of this portfolio now, is going to be the average beta of all the forward of all the 4, what do you call it? All the 4 investments, okay? Of all the 4 investments, because I have 4 investments in my portfolio. Do you understand?
Yes, sir.
Okay. So from what I said here, it means that we are going to multiply. Okay? Look at our return here. Okay? Sorry. Look at our beta here. Can you see that beta? Multiply this beta by the weight. What's the weight? Is 10%, 10%, 10%. If add all this together, it's 50%, Abby. The question has told you that 50% of your investment was invested in a risk-free. So it is the balance of 50% that you put in this on this portfolio. Therefore, the beta of my portfolio is this times 10%, this times 10%, this times 10%, and this times 20%. Add everything together. That is a beta of the portfolio. Do you understand that?
Okay.
So let's go and do that. Or you can do it. Can you do it? Anytime the question asks you, anytime the question asks you to compute beta of portfolio, that's what I'm going to do. It's as simple as that. Too. Just pick the beta, multiply by the weight. Okay? This times the weight. This times the weight. Okay, let me go and do it for you. Probably, let me see. That's going to be the last question we're going to solve in portfolio theory. Let me see whether we have other question that will be, I can pose interest to you. Okay. We even have more than this.
So 5.
We did what?
So solve 5, example 5. Or you just tell us how to solve it.
5, let me check. Where's the 5? You are scared already, are you?
This portfolio theory is confusing. It's now that I'm beginning to
Understand it.
understand it. It's really confusing. You might think that you know it, why you don't all these simple things.
Okay. I'm already hungry.
Sorry, sir. Sorry, sir. Not easy.
Okay, let's continue. Let's go and compute the beta of the portfolio. That's example 4, Abby.
Yes,
The one we
sir.
solved yesterday, right?
Yes, sir. Example 4.
Are you not getting portfolio now? If portfolio come up, you should be able to get cheap money from there. And it's most likely that the portfolio, most likely. I'm not saying 100%, so don't quote me. Most likely. So, example 4. Computation of beta of the portfolio. Computation of the beta of the portfolio. Computation of the beta of the portfolio. So let me insert my table. Okay. So we have what they call it, asset or what? Asset, yeah. Asset. Better. Oh, see how to add one again. Asset, better, weight. Weighted average. So we have a B, C, D. So what is the beta? Do you have the beta there? Give me the beta of those securities, of those assets.
0.2,
0.2,
0.8,
0.8,
1.2,
1.2,
and 1.6.
1.6. Weight, 10%.
10, 20. 10 again. 20.
And 20%. So 0.2 times 0.1 is what? 0.2. 0.02.
2.02.
Abi?
Yes.
It is 0.08.
0.08.
0.12. Am I correct?
0.12.
This will be 0. Is it 32?
0.32.
0.32. So, beta of portfolio. Beta of portfolio is the sum of all these weighted average. So sum everything together, what do we have? Okay, wait. We have one that we have not added there. Sorry. You know, the investment we have one that is in risk-free. This 50% now. You know, we have one that is 50%. Abi? The 50% is in which asset? The risk-free asset. So you have to consider that as well.
Okay.
So we come here, risk-free. Risk-free asset. Now, a risk-free asset, you know it's risk-free, Abi? What does beta measure? Risk, Abi. So if I now have my asset in risk-free asset, will it have a beta?
No, sir.
No. So the beta will be 0. An investment that is risk-free will not have beta. So the beta is 0. And the weight there is what? The weight is 50%. Because it's 50% of our investment that we are putting there. So 50 times 0 is what? Is 0.
Yes.
Do you understand now?
Yes, sir.
So you have to include that risk free rate to make it complete. because your investment is 100%, 50% in risk-free, 50% in risky assets. So the one that is in risk-free will not have beta because it's not having risk, because beta measures risk. And since it's risk-free, the beta will be 0. So add everything together, what do we have?
Is that 0.54.
0.554.
Yes,
That's the beta of the portfolio. You can see that it's not difficult, Abby. That's the beta of the portfolio. That's the beta of the portfolio. So B, what's requirement B? Assuming that you want an expected return of 12% and intend to obtain it by selling some of the risk-free assets and using the proceeds to buy the market portfolio, calculate the set of weight in the invested portfolio. Please give me 1 minute. Let me use myself. 1 minute. Okay, sorry. Back. I'm coming. Now, assuming that you want an expected return of 12%, you want an expected return of 12% and intend to obtain it by selling some of the risk-free assets and using the proceeds to buy the market portfolio, calculate the set of weight in the invested portfolio. Now, what are we going to do here? Hope I've not dropped. I'm coming. Okay. I thought we jumped a question. Now, this is what the question is telling us, that, okay, out of all this investment that you have, how many investments? We have 5 investments, have you? Out of these 5 investments, you want your aim is to achieve 12% return. And for you to achieve this 12% return, you want to sell some of the risk-free assets. Our risk-free asset is 50%, Abby. You want to sell some of them. Now, whatever you sell, you want to use the proceeds to buy the market portfolio. Okay? You want to use to buy the market portfolio. You sell part of the risk-free asset. You want to use it to buy the market portfolio. So calculate the set of weight in the invested portfolio. So this is what I'm going to do. Let me show you. You have okay. Let me go to the next line. Okay. So let me go and start this. When I do it, that's what I'm doing. 2, 3, 4. A, B, C, D, E, F. Oh. Okay. This one I need. This B. That's B. Revised weight of the portfolio. So look at what is happening here. Currently, we have security or asset, call it assets. We have asset A, B, C, D, E. Now, my E here, the one I call it here is the risk-free. Do you understand? The risk-free is what I represent by what? By E. Are you there? That's all right. Are you with me?
Yes.
The one here, the risk-free asset is what I use letter E to represent. Do you understand? Now, what is the current weight of this? Okay, what is the return first? What are the returns? Do you have the returns there? Can you give me the returns? Go up. These are the returns. And for the risk-free, for risk-free rate, for risk-free asset, the risk-free rate is the return. What's the risk-free rate? Where is it given? I'm supposed to be given risk-free rates. Let me see. Should be given. Except it is an omission. Yes, I believe. There is an omission in that question. There is an omission in that question. Now, we are supposed to be given risk-free rate. Supposed to be given risk-free rate. Supposed to be given risk-free rate. So what will happen is let us assume a risk-free rate, because let me tell you the reason so that you understand what I'm doing. You know, for asset A, this is the return, Abi. For B, this is the return. For C, this is the return. For D, this is the return. What's the return for the risk-free asset? This asset here, what's the return? I know it's risk-free. So a risk-free asset should have a risk-free rate of return. Let us assume 6%. Are you there? Let us assume 6% risk-free rate. Let us assume 6% risk-free rate. So if I'm assuming a 6% risk-free rate, it will mean that, okay, give me the return for A, B to D. What are the returns?
Returns.
A, B, C. 7.6%.
12.4%.
7. What do you call it?
6%.
Okay. Next.
12.4.
12.4. Okay.
15.6%.
I didn't hear you.
15.6%.
Okay. 15.6%.
18.6%. 15.6.
Okay.
18.8.
18.8.
18.8. 18.8.
Okay, 18.8. Okay. And this one should be 6.0. That's the risk free. Now, the new one we want to buy, look at it too. Let me go back to that question. But the information we miss here, there are even two information that I'm missing. Now look at it too. We want to sell. We want to sell part of the risk-free asset, Abi. We want to sell part of the risk-free assets and invest the proceed in where? We want to invest the proceed in the market portfolio. So two things are missing here: risk-free rate and market return. Market return is the return you're going to get in the market. Okay? The return you're going to get in the market is the market return, risk-free rate. So it therefore means that if I sell part of my risk-free asset and I invest the proceed in market return, I should get the what? The market return. So if I invest in market portfolio, I should get the market return. So let us assume that. Are you writing the assumption?
Yes, sir.
Okay, let us assume that the market return is 14%. So we are assuming two things. We assume risk-free rate of 6%. We assume market return to be 14%. So therefore means that I will spend 14%. So I will get 14%. That's the first thing you need to do. Now look at it now. Let's get our weight. Now, you know, it used to be 10%, Abby. 10%. Do you remember? 10% for A, 10% for B, 10% for this, Abby. Sorry, 20% for D, right?
Yes, sir.
Okay. Now, When you come to risk-free is supposed to be 50%, true or false?
True.
Now, but we are selling part of it. We are selling, look at it. You want a return of 12%, and you want to obtain it by selling what? You want to sell some of the risk-free assets. You have 50% before, Abi. You want to sell part of it. I don't know the amount you need to sell for you to get 12%. So I will use a letter to represent it. So I'm assuming that I'm going to sell K. Out of this, I will sell K. K represents a number that I don't know. Do you understand this? K represents a number that I don't know. Hello?
Yes, sir.
So whatever I sold here, which is K, I'm using it to buy what? I'm using it to buy the market portfolio. So whatever I sold here, which is K, I will invest it in the market portfolio. So market portfolio will now have K. It's like I'm removing K from this period and putting it in what? In market portfolio. So what will now be the weighted average? Weighted average. There will be 0.76, 1.24. Are you there, please? I know you are tired.
No, we are with you, sir.
1.56, okay. Then we have, this will be 1.8 times 2. What do we have? One 1.88 times 2. 3.7. 3.76. Did you get the same thing?
3.76.
3.76. Now, this one will now be, for this one now, we are going to use this 6 to open the bracket. This one now will be in form of bracket. You now have 6 times 50. Don't forget it's 50%, Abby. Let me put percent so that it does not confuse. 6 times 50% is 0.5. So it's 0.5 times 6. Is 0.5 times 6 is what? Is 3. Abby? You also use that same 6 to multiply K. So I have minus 6K. So I have 3 minus 6K. For this one, 14 times K will be 14K. Will be 14K. Now, what will I now do? What is now the weighted average? The total weighted average here. The total weighted average will now be sum everything together. Sum everything together. How will I sum? Those ones that have numbers, add them. 0.76. Are we there? 0.76 plus 1.24 plus 1.56 plus 3.76.
7.23.
You said?
7.23.
10.32.
32.
I said you are already tired. So 7.32, right? So 7.32. This one is 3 here. Now say plus 3. Plus 3 will be 10.32, Abby. 10.32. Now look at this one. This one is minus 6, Abby. Minus 6K. This one is what? Plus 4K. Plus 14K. 14 minus 6 is what? 14K minus 6K will give us what? 8K. Am I correct?
Yes, sir.
So I'm going to get 10.32 plus 8K. 10.32 plus 8K. My aim, what is my target return? What return do I want to achieve?
Expected return 12.
12, Abi. So I will now say, okay, if I want to achieve expected return, I will equate this one to 12 so that I will know how much of the risk-free rate I will sell. You know, it represent the risk-free rate I should sell, Abi. The risk-free asset I should sell. So if I want to get 12%, I will now say 12 is equal to 10.32 plus 8K. 10.32 plus 8K. Or let me put it in a better way. 10.32 plus 8K is equal to 12. Is equal to 12. So I will collect like times. I will have 8K is equal to 12 minus 10.32. 8K is equal to 12 minus this is 2.32. No.
1.68.
1.68. So K will be equal to 1.68 over 8. That will give us what?
0.21.
0.21, which is 21%. What does that mean? It means that if I want to achieve a return of 12% by selling part of my risk-free asset and using the money to buy the market portfolio, I need to sell 21% of my risk-free assets. So whatever the proceed is what I need to invest in the market portfolio so that I'll be able to get 12% return. Now, the question does not stop there. The question says, calculate the set of weight in the invested portfolio. So what will now be our weight? What will now be our weight? I will copy this one. Look at what will be our weight now. I just copied this one. So I call it weight of the new portfolio because my portfolio has changed. My portfolio has changed in the sense that I've added another, what do you call it? I've added another investment to it. So this one will not change. This one will not change. My K is 21. So 50 minus 21 is 29. Is 29. So if I'm investing 29%, are you there? Hello?
Yes, sir.
So I'm investing 29%. So also here, I will have what? I will have that 21 I remove from here will now come here because whatever I sell from here is what I'm investing here. So it means the new weight is going to be, I don't need this column. Let me remove it. It's only weight that I'm asked to calculate. Remove. Column. Yes. Even this return to, I don't want it. I only need the weight. I only need the weight. So I can just straighten this one here. So this also a percentage. This also, if you add everything together, you're still going to have 100%. So by the time I set up my risk-free asset, which is 21%, and I invest it in what? In the market portfolio, the percentage left on my risk-free asset will now be 29%. And that 21% will not be invested in the market portfolio. It's like we are tired, are we? Hello?
No, sir.
Now only you know tired. The other two have gone.
Ah,
The other two have gone.
what happened now?
Only you remaining. If they are tired.
Are you not going to do the bond listing again?
Maybe we are still going to have another class with that. On Saturday, but sorry, on Sunday. Yes. Should be on Sunday.
For the bond valuation.
Yeah. For the bond valuation.
You will not have time before that Sunday again.
I have a lot of things that is pending that I need to do. Honestly.
I know.
Honestly. A lot of things. And I want to give you like 3 hours on that Sunday. And you go to church on Sunday. That's another issue.
In the morning.
I wanted to fix it because, you know, Sunday is our pre-sim at FC.
Wait, morning, what time?
Pre-sim will be around 1. But I have to leave home around 10. Or latest 11.
Okay.
You go to church. Let me see.
Anytime you fix, Sha, anytime, because that bond, this is very important.
And you know, we have not even finished this one. We have to finish this one. And that's question 5. I'm also going to solve it for you as well.
Okay, sir.
Then plus bond valuation. So maybe we should fix, if I study my Saturday, if Saturday will be feasible, I fix it on Saturday. Otherwise, I will fix it on Sunday. I think it's better that way.
Okay, sir.
Or what do you think?
Okay, sir. Everything depends on you.
Okay, so we are going to have another class, either Saturday or Sunday. I will communicate. If it is going to be Sunday, then it's going to be in the morning. You just have to bear with me, please. Because I know you want to go to church. Emma Binu, do you speak Yoruba? Where?
No, sir.
You don't know Emma Binu? When is Emma Binu?
No, sir.
Okay. So no problem. We still have one more class before the exam. That's what it means. But did you understand what we have done today so far?
Yes, sir.
Very well.
I will still need to go through.
Is it that you have not been ready, or you understood everything we did? Because I've not been seeing questions from you people.
Sir, you're always busy.
You have never asked me a question. If you ask me a question, even though I don't respond immediately, when I'm done from the office, I will definitely call and explain to you. You have asked me some question before now. Didn't I respond?
You did.
So if it is not immediate, because I'll be in the office, definitely I will respond later. But I'm not seeing question from especially you and Mrs. Angela. This Mrs. Shiu, she's still asking some petty question. But you are not asking any question at all. So please revise the exam by next week. This time, the whole ICANN exam is good. Let's just try and give it our 100% attention for now. Okay?
Okay, sir.
All right. So we meet on Saturday or Sunday. By God bless. Good night.
Oh, okay. I thought we are going to finish solving this one.
No, when they are no longer available. You are the only person here now.
Sir?
You are the only person remaining. So I think Mrs. Angela is said now. I would have said, okay, let us conclude it. Because you could have formed a quorum. The 1/3 is 33%.
Okay,
Do you
sir.
understand me?
Okay, sir.
But we are still going to solve it, don't worry. I promise you that. So good night.
Good night, sir.